Hey guys, I really enjoy this YouTube community we've built around dividend investing. I appreciate what you guys bring to the table, and I just enjoy having people to kind of bounce ideas off of. So I am glad you're here. Today, I began to, as I do periodically, look at my portfolio in terms of what investments that I have in there. And so I thought, why not invite you guys along on that journey? We'll just kind of talk about these one at a time. This will be a series. We'll talk about dividend growth investments first. There will be different categories of that, but we're in the dividend growth investing series. And we're going to look at the first stock today that I thought would be helpful for you guys, and that is Intuit, which is ticker symbol INTU. So, welcome aboard. If you like this kind of stuff, be sure to like and subscribe to the channel so you can see what stocks we're going to talk about next. There will be at least 10, maybe 11 of the dividend growth investing series. Then we'll move on to the the income series, and then the value investment series. So we're going to be at this for probably, 2 or 3 months. So if that's something that you're interested in, like and subscribe. Make sure you don't miss a one. So with that, let's get started. I want to show you guys, where we're headed with this. So this is the 4Ks. The 4Ks are, I want to know the business. I want to know the financials. I want to know the capabilities of the management team. And I want to know the investment thesis. Where am I planning to make money from this investment? And always as a caveat, if any of these Ks change, it might be time to reconsider the investment. So it's always good to stay on top of the investments that you have. Here's how I determine my thesis for investment. I look for really one of three things, and it's usually a combination of all three things, but one is usually predominant over the other. One is value investment. So if the stock price, the current stock price for the business is trading below its intrinsic value, what that means is that investors are not appreciating the intrinsic value of the investment. So, you have to question whether, sorry about that, you have to question whether the stock market has it right or whether the stock market has it wrong. What we're looking for are companies that the stock market has it wrong. We're looking for, whether that's from fear, whether it's from, just sentiment. There could be all kinds of things that drive the stock market to the wrong conclusion. We're looking for those instances with value investments. The next category, or the next investment thesis, is income. That was kind of pretty easy to think about. Those are dividends. They are investments that are providing an above market dividend yield. We probably do not expect a large growth in capital from those, but we are expecting to get that dividend yield. So income is the second thesis. The third thesis is growth, and that growth can come from many areas, but we at Wealth Circuit Investing, what we look for are businesses that are growing, and but growing in a way that incorporates the investor. And that usually means I like to have a company that pays a dividend. It doesn't have to be a big dividend, but I like for the investor to be a part of the team. So with that, I typically look at dividend growth investing. So now let's take a look at Intuit. So I went back and looked at their strategy. I thought I would share a little bit about their strategy, about their financials, about their management team, and then ultimately, what am I going to do with this thing, right? Where am I going to head with that? So they have an AI-driven, what they call an expert platform. They believe in a formula called data plus AI plus HI equals growth. And we all know what data is. AI is artificial intelligence. That's the big buzzword these days. But they're also adding something called human intelligence, where they're wanting their human assets, the people that work at their firm, to utilize data through AI to help drive productivity in small and medium-sized businesses, as well as the consumer through their TurboTax software and Credit Karma as well. So know the business, right? We know that they're focused on consumers, small business, mid-market businesses. They're not looking for the large companies and things like that. So I believe there's a pretty good niche here for Intuit. The next thing is they have three big bets. One is that they are going to deliver what they call done-for-you experiences. That's the correlation of this data plus AI plus HI. They're going to look to have small to mid-sized businesses improve their efficiency and effectiveness through utilizing the platform that Intuit brings to the table. They want to accelerate money benefits, so they want to shorten the time between when these small and mid-sized businesses provide a service or a product and when they get paid. So that's a big benefit, right, for customers. And then they want to fuel success for mid-market businesses. I think they understand that that's a pretty big market niche, and so it'd be worthwhile getting into that. So that's know the business. Now know the financials. So looking here at the sales growth over the last, what is this, 2000? So the last 10 years, pretty significant double-digit growth every year. So they're doing well on the sales side. Sales are up and to the right. Looks like they're kind of flat. Well, that's the last 12 months. So it would make sense that 2025 and the last 12 months are the same. So shares outstanding they've risen a little bit, and that's not terribly concerning to me because they've made some big acquisitions in 2020 and 2021, I believe, with MailChimp and Credit Karma. So those are some big acquisitions that they've had. Check out this return on invested capital. It's about 15%. That is a good return on invested capital. If you're not familiar with how that would work, they're getting a return on every dollar that's invested in the business to the tune of about 15%. And if you think about what it costs to borrow that money, it costs maybe, somewhere around the 7, 8, 10% range to borrow that money, depending on what percentage is equity versus debt. There is a cost to capital. So there's no doubt that the return on invested capital exceeds the cost of capital in the case of Intuit. Their net debt, this is really kind of cool. It's only about 10% of their total cap structure. So we like that. They don't have a large amount of debt out there. And check out this interest coverage ratio. Back in the 2020 range, it's 157. Now it is 20. We like it to be over 8. So very manageable debt situation. So let's move on then to knowing the capabilities of the management team. I think one of the best ways to do this is to see where the management team has driven the business over the last 10 years or whatever. And in this case, you can see that in fiscal year 14, they grew the revenue by 8%. In 19, it's 13%. Now here we are in fiscal year 25. They've grown the business by 16%. The target for 2030 is to be at 20% growth in revenue. So I think, they've got a lot going on there. I'm really pleased with what I'm seeing from the management team. So then knowing the investment thesis, we talked about the three, and there are others. Maybe if you would put in the comments what you think some other investment theses are. I know a couple off the top of my head, but I don't really invest in them a lot, so I don't put them on my list. But if you got any thoughts on that, let me know in the comments below. But the investment thesis for Intuit is growth. It is dividend growth. And so as I look, this is really what you want to see. This is what I want to see when I'm looking at a dividend growth investment. I want to see dividends that are growing. That's a, that's no shock, right? You want, in a dividend growth paradigm, you want to have dividends that are growing. That's a pretty common theme. But take a look here. You also want an earnings payout ratio that is flat or lower. And in the case of Intuit, it is actually lower. Now, what does that mean? That means that earnings, since their earnings payout ratio is declining, that means that the dividend increases that we've seen, which over a 5-year period is in the double digits, 14.4%. Those dividend increases are not growing as fast as the business is growing. The business is growing faster than the dividends are growing. And we're okay with that because management is sharing with the investors, out of the success of the business. They've got a really good capital allocation process. You can see here that you want earnings going up and to the right. You want dividends going up and to the right, and you want the earnings payout ratio to be flat or declining. And what that means, and let me just boil it all down, what that means is that any increases in the dividend are coming from the success of the business strategy. That's what we want, and that's what I see here with Intuit. All right, let's take a real quick look at my spreadsheet. I have a spreadsheet where I track 132 maybe is it 132 or 131, somewhere in there, investments that I want to keep an eye on, and they are really my watch list. But I have a process where I allow the investments that I think are more profitable to rise to the top. And Intuit is actually the number 8 investment on that chart. So you can see that I have it rated as a buy. It's about 1.8% of the portfolio. I believe that Intuit can provide return potential of around 18% over the next 12 months. Analysts, however, are saying it's around 26%. So I'm a little bit more conservative on that. Morningstar says they have a wide moat. That means that they have the ability to get excess earnings from their products and services over, let's say, a 20-year period of time. That's the way they define it. Also, the percentage of fair value, they are undervalued. So this is an indicator of, where there's a potential for, additional gains from being a value investment, because it's actually under the intrinsic value that Morningstar has calculated for it. We see this, mid double digit return on invested capital, has a medium uncertainty, which is good. That means that it doesn't have a lot of uncertainty around it. Check out this dividend safety rating of 98. That's per Simply Safe Dividends. They have a payout ratio of around 21%. That is very low. That's really a great number to have. And you can see here they've got a dividend yields very low, 0.7%. So Intuit is really a combination of those three. It has a bit of value, it has a bit of income, but the majority of the investment thesis is growth. It is growing like crazy. So can they pull it off? Can Intuit pull off this strategy? I hope so, and I'm kind of betting on it. So I have put 1.8% of the portfolio into it, and I'm really considering putting another maybe 0.7 to 1% in there to get it about what I would consider a normal weighting in the portfolio, around 2.5%. So that's where I'm at with Intuit. Give me comments below if you agree or disagree with my take on Intuit and whether or not you think it's a good investment for your portfolio. As always, I just want to share what my journey is with you. I'm not suggesting that you buy Intuit or not. I don't know your goals. I don't know if it fits in your portfolio. You're the one that can determine that. And so I just wanted to share what I had learned here, what the process is that I go through, and share that with you. If you like it, you can borrow it. If you don't like it, all it cost you was a little bit of time. So with that, guys, I will see you on the next video.